Welcome, everyone, and thank you for joining me today. Today, we'll be taking a detailed look at the Urban Company IPO. Our focus will be on helping you decide whether to apply or avoid by exploring both sides of the story. We'll cover the key aspects of the IPO, its potential, and the risks involved. So, let's get started and dive into this exciting analysis. Today, let's take a closer look at the key facts surrounding Urban Company's upcoming IPO. The issue is scheduled to open from September 10th to September 12th, 2025, with an anchor book opening a day earlier on September 9th. The price band for the shares has been set between 98 and 103 rupees, and each lot will consist of 145 shares. The total issue size is approximately 1,900 crore rupees, which includes a fresh issue of 472 crore rupees and an offer for sale of 1,428 crore rupees. The shares will be listed on both the NSE, which is the designated exchange, and the BSE. When it comes to allocation, the majority of the shares, about 75%, will be reserved for qualified institutional buyers, or QIBs. About 15% will go to non-institutional investors, and the remaining 10% is set aside for retail investors. These details are crucial because they give us insight into investor interest and how the company plans to raise capital. Overall, this IPO is a significant milestone for Urban Company, and understanding these key facts helps us gauge the scale and scope of the offering in the context of its growth story. Let's take a moment to look at our business overview. We are India's leading app-based marketplace for home, beauty, and wellness services. This means we connect customers with trusted professionals for a wide range of services right through our platform. We operate across 51 cities, not just in India, but also in the UAE and Singapore, which shows how our reach is expanding beyond national borders. This international footprint helps us tap into new markets and grow our presence. Additionally, we're not stopping at services alone. We're expanding into the hardware space with our native line, which includes products like water purifiers and smart locks. This move allows us to diversify our offerings and create a more integrated ecosystem for our users. All these points highlight our growth strategy, strengthening our core services while branching out into new areas to serve our customers better and stay ahead in this competitive landscape. Let's take a quick look at our financial snapshot. For FY24, we reported a revenue of 827 crore rupees, but unfortunately, we also faced a loss before tax of 93 crore. However, there's good news on the horizon. In FY25, our revenue has grown significantly to 1,144 crore rupees, which is a 38% year-over-year increase. That's a strong indicator of our growth trajectory. Additionally, our profit after tax is approximately 240 crore rupees, with a profit before tax around 28 crore. This clearly shows we're moving towards profitability. Focusing on the first quarter of FY25, we achieved a revenue of 281 crore rupees and a profit before tax of 12 crore. All these numbers reflect a positive shift. We're swinging towards profitability, and that's a key milestone for us. It aligns perfectly with our overall theme of sustainable growth and financial resilience. Now, let's take a closer look at how we plan to utilize the fresh funds of 472 crore rupees. First, a significant portion, 190 crore rupees, will be allocated to technology and cloud initiatives. This is crucial because strengthening our technological infrastructure will support our growth and scalability. Next, we have 75 crore rupees earmarked for office lease expenses. This ensures that our team has a solid and comfortable workspace, which is vital for productivity and collaboration. Then, we are allocating 90 crore rupees to marketing. Investing here will help us expand our reach, build brand awareness, and drive customer engagement. Finally, the remaining funds will be used for general corporate purposes. This provides us with the flexibility to address other strategic needs as they arise, supporting the overall health and growth of the company. Overall, this allocation reflects our balanced approach to investing in technology, infrastructure, marketing, and corporate needs to propel us forward. Let's take a closer look at the valuation at this price band. For FY25, the price-to-earnings ratio is expected to be between 59.4 and 62.4 times, which is significantly higher compared to the Nifty 50, which is around 21.6 times. This indicates a premium, reflecting strong growth prospects or market expectations. Additionally, the price-to-sales ratio ranges from 12.3 to 12.9 times, suggesting how the market values each unit of sales. When you compare these multiples to broader indices, it highlights the premium investors are willing to pay here. The implied market capitalization at this valuation is approximately between 14,100 and 14,800 crore rupees, giving us a sense of the company's scale within the market. Lastly, there's the GMP, or gray market premium, which is unofficially around 26 to 27%. This premium often indicates investor enthusiasm and demand ahead of the official listing, although it's not an official figure. Overall, these valuation metrics help us understand how the market perceives this opportunity, reflecting not just current performance, but also future growth expectations. Let's talk about some of our key strengths. First, we are a category leader in a large, underpenetrated market. This means there's still a lot of room for growth, and we're well-positioned to capture a significant share of this expanding space. Next, we're seeing improvements in our unit economics and overall profitability. This is a strong indicator that our business model is becoming more efficient and sustainable as we scale. We also benefit from strong network effects and brand recall. Our products become more valuable as more users join, and our brand remains top of mind for consumers, helping us maintain a competitive edge. Finally, our native products are designed to extend lifecycle revenue. By creating offerings that naturally fit into our ecosystem, we encourage ongoing engagement and repeat business, which supports long-term growth. All these strengths align with our overall goal of building a resilient, scalable, and customer-centric business. Let's take a moment to look at some of the key risks we need to keep in mind. First, there's the issue of valuation. Currently, our valuation is quite rich compared to our peers and the overall market, which could pose challenges if expectations aren't met. Next, we have the gig worker model sensitivity. This is an important one because it depends heavily on the supply of gig workers and the evolving regulatory landscape around gig work, both of which can change rapidly and impact operations. We also need to consider reputational and compliance risks, especially in the services segment. Any misstep here could affect customer trust and lead to regulatory scrutiny. Another point is our heavy reliance on the OFS-heavy model, which means we're somewhat limited in fresh capital infusion. This could constrain growth opportunities or operational flexibility if not managed carefully. Finally, there's the geographic dependence. We're highly dependent on top metropolitan areas, which, while currently lucrative, also makes us vulnerable to regional economic shifts or policy changes. All these risks are interconnected and important to our overall strategy. Recognizing them helps us plan better and navigate potential hurdles effectively. When it comes to our decision framework, it's important to consider certain factors that can guide our approach. First, we should evaluate opportunities that offer an expected compound annual growth rate of 25 to 30% or more, along with potential margin expansion. These are the kinds of investments that can really drive substantial value over time. We're also comfortable with high multiple bets, meaning we're open to investing in companies that might have higher valuation multiples, especially if the growth prospects are promising. And, of course, we're targeting listings that could lead to significant gains, which can enhance our overall portfolio. On the other hand, there are situations where we might want to avoid certain investments. For example, if an opportunity aligns more with value or low-risk strategies, that might not fit our current focus. We should also be cautious with structures that are overly reliant on offer for sale or OFS processes, as they can introduce additional complexity and uncertainty. Additionally, if clear visibility into profitability isn't apparent, that could be a red flag. We want to ensure that the companies we consider have transparent, understandable paths to profitability, so we can assess their sustainability and growth potential confidently. Overall, this framework helps us align our investments with our strategic goals, balancing high-growth opportunities with prudent risk management. So, to wrap things up with the bottom line, we see a strong business model here that's showing improving profitability over time. That's definitely a positive sign for the company's growth potential. However, it's important to note that the current valuation is quite stretched, meaning the stock is priced for perfection. Investors should be aware that expectations are high, and any misstep could impact the share price. There is also potential for listing gains, especially if the positive GMP, or gross market price, continues to hold. But for long-term investors, I would advise being cautious and sizing your allocation carefully. It's about balancing the attractive growth prospects with the risks associated with a lofty valuation. Overall, this slide encapsulates the key takeaways: a solid foundation with growth opportunities, but also a need for careful positioning given the current market pricing.